Welcome to discuss investment banking. Today we'll be looking at module 1, which is Introduction to Investment Banking and Global Capital Markets. This module will introduce investment banking as a critical component of the global financial system. It will also explain how investment banks connect those who need capital with those who have capital, enabling efficient allocation of financial resources across economies. By way of module objectives, by the end of this module, the students should be able to understand the concept of investment banking and its role in financial systems, explain how capital formation and financial intermediation occur, differentiate between primary and secondary markets, distinguish equity and debt markets, identify service provided by investment banks, and understand global capital market structure and capital flow. By way of introduction, investment banking serves as a bridge between capital seekers and investors. Governments, corporations, and institutions rely on investment banks to raise funds, while investors depend on them to identify profitable opportunities. Unlike commercial banks or banking, investment banking focuses on capital raising, advisory services, and structuring large financial transactions. This makes it essential for economic growth and global financial stability. Now let's look at capital market. What the capital market really is about. The capital market provides the environment where investment banking activities take place. These markets allow funds to move across countries, connecting surplus capital regions with deficit regions. They include equity markets, debt markets, and money markets, each serving different financial purposes. Then we have global nature of investment banking. Investment banking operates globally, linking developed and emerging markets. Institutions in the UK, US, and EU, that is European Union, they interact with markets in Africa and Asia, enabling cross-border investment. However, this also introduces complexities such as currency risk, regulatory differences, and geopolitical challenges. Now, let's look at the proper definition of investment banking. What is investment banking? This is a specialized financial service that focuses on facilitating capital movement between investors and organizations. It supports economic growth by ensuring funds are efficiently allocated to productive use. Let's look at what capital formation is. What is capital formation? Capital formation involves raising funds from investors and allocating them to organizations. So capital formation is when organizations raise funds from investors and they allocate them to organizations. This is what investment one of the functions of investment banks. Investment bank helps companies to issue shares or bonds, determine pricing and market security, enabling large-scale funding for expansion and development. Let's look at another function or another role of investment bank. Investment bank also act as intermediaries between investors and issuers. They reduce information gaps by conducting analysis, due diligence, ensuring transparency. This will help improve market efficiency, liquidity, and trust. Another role of the investment bank is advisory services. They provide advisory services when there is a merger, when there are acquisitions, when there is restructuring, and when there is strategic investments. They carry out advisory services. They also analyze financial data, structure deals, negotiate terms, and ensure regulatory compliance for complex transactions. Now, what role does investment bank play in the financial system? Investment banks facilitate capital flow, they advise on financial strategy, and they connect investors with opportunities. Their activities support infrastructure development, business expansion, and global economic integration. Now let's look at the structure of capital markets. What is capital market? Capital markets are structured or organized systems where long-term financial instruments are issued and traded. They are divided into two: primary and secondary markets, equity and debt market. So the capital market is basically divided into two categories: primary and secondary market, and equity and debt market. Now let's look at primary market. Primary market, this is where new securities are issued. Investment banks help company conduct initial public offerings, which is IPOs. They help companies also determine pricing for shares and also help companies distribute their shares. This enables organizations to raise fresh capital for growth and development. Let's look at the next one, which is the secondary market. Secondary markets involve trading existing securities. So while primary market is for trading fresh securities, secondary market is for trading existing ones. That means you have bought shares before you want to sell them. You sell in the secondary market. But if you want to sell for the first time, or if a company wants to go public for the first time, there's say using the primary market. So they provide liquidity and price discovery. Stock exchange such as the New York Stock Exchange and the Nigeria Exchange Group allow investors to buy and sell securities easily. So this is a platform for trading. Now let's look at the equity market under the second category of capital markets. Now, under the equity market, it involves ownership instruments such as shares. Investors gain dividend on these shares and capital appreciation, but they face higher risk. Investment bank, they support equity issuance and advisory services. I already explained this earlier. What about the debt market? Debt markets involve bonds and similar instruments. Investors lend money and they receive interest payments. So whereas equity market, investors buy shares and they receive dividends. In debt market, they lend out money and they receive interest payments. These markets are generally lower risk but offer lower return compared to equities. Let's look at some of the core services of the investment banks. Investment bank provides services including underwriting, merger and acquisition advisory, corporate restructuring, and capital raising. These services support major financial decisions and transactions. Now, let's look at the first function, which is underwriting. Underwriting involves helping companies issue securities and ensuring they are sold to investors. So, what is underwriting? This is when companies issue securities and ensure that they are sold to investors. So, what does investment banks do? They analyze the companies, they set the prices for the shares of the company, and sometimes they take on the risk of purchasing the securities before selling them to the public. Now, another function they carry out is merger and acquisition. But what is merger acquisition? Merger acquisition involves combining or acquiring other companies. Investment banks, they provide valuation. To value business means to know the worth. They negotiate on behalf of the businesses and they structure support for complex deals. Now let's look at corporate restructuring. Corporate restructuring involves helping struggling companies reorganize finances, reduce debt, and improve efficiency. Where what does investment bank do in this case? They guide companies through this process. Now let's look at capital raising. Capital raising involves obtaining funds through equity or debt. I already explained equity. Equity is when you has to do with buying shares in companies, while debt has to do with lending money for companies for interest as reward. What does investment bank do here? Investment bank advise on the best method and connect companies with investors. Let's look at financial instruments. Financial instrument includes shares, bonds, treasury bills, commercial paper, and mutual funds. They represent ownership, debt, or pooled investment. Let's look at the first one, which is share. What is a share? A share represents ownership in a company. Investors, like shareholders, earns returns through dividends and price increase, but face higher risk due to market fluctuations. Let's look at bonds. What are bonds? Bonds are loans to government or corporations. They provide regular interest payment and return of principal, making them relatively stable investment compared to shares. Let's look at treasury bills. What are treasury bills? Treasury bills are short-term government securities issued at a discount and redeemed at full value. They are considered as very safe investment. What about mutual funds? Mutual funds pool investor funds and invest in diversified assets. They provide professional management and reduce risk through diversification. So mutual fund is when investors they put their funds into different investments. Now, by way of conclusion, this module introduced investment banking and global capital markets. It explained how investment banks facilitate capital flow, structured markets, and support economic growth. Understanding this concept is essential for analyzing financial systems and making informed investment decisions. At the end of this module, there's an assessment where part A involves 15 MCQs and part B, which involves a report. I'll see you in the next module.